Welcome to the daily update, where I'll go over the action in the market for Friday, January 10th, and we'll see how things look for Monday, January 13th. Okay, the employment situation report came in hot, much greater than expected, and that spooked the bond market, which sent interest rates up. That's already been a problem for stocks. Interest rates have been going up. And as they keep going up, that's pressuring stocks right now, sent them down. We ended up having quite a down day, um, about 1.5% or so. But we are at some possible support that I'll pick up and talk about as we go through this. But we are negative, and in the short term, we are oversold. Now, we take this a little bit more seriously when we're oversold and the longer term trend is still positive. Now, we could still break below where we're at, but we have a longer trend that's positive, a shorter term trend that's negative. So we might get some kind of a bounce out of this next week. We'll see. At some point, is the smart money going to come in and actually do some buying? We keep breaking below levels. We still have growth versus value looking pretty strong. Discretionary to staples still looking pretty strong. Are we going through a period right now that's creating a lot of doubt in folks that just assumed that the market was going to go up? So they started loading up on calls. They started getting into stocks thinking, oh, it'll go up. It's the first of the year, January effect, Santa Claus rally. We went up in 2023, we went up in 2024, so we're gonna go up again in 2025. The market doesn't like that, and it doesn't like to be taken for granted. And this could be some real doubt coming in. At the same time, if you go back to 2021, we were looking really solid at the end of 2021, and we were looking pretty good at the beginning of 2022. Then it started to morph over into a more negative picture. It took some time to work out, and then we ended up going into 2022, which was a cyclical bear market, and we actually switched with a long-term trend to down. And it was then in October of 2022 when we finally bottomed. It's a very difficult year for folks that are long in the market, and then we were finally able to come up out of that. Is there something developing like that now? Not saying it is, not saying it isn't. We're just going to watch it as it unfolds, take it from there, and then reevaluate things on a day by day basis. All right, let's go back and talk about what happened. Right at the open, we had a gap lower open. The unemployment report or employment situation report came out, it comes out an hour before the stock market opens. And it's one of the few times when I tune in for just a few minutes into the financial media. I don't watch financial media, but if there's some factual number coming out, well, of course, you can even debate that the reports that we get are factual. But if it's the number that we're going to be given, that's all I want to see. Just how did the report come out? And then they go into all their analysis and they get their panels together and their experts. I'm long gone by then. I just want to see what the numbers are. I'll watch the futures myself, see how the market is reacting to that. And they reacted negatively. That ended up producing a gap lower open, and we immediately dropped down below S1 at 58.86. We got down below S2 at 58.54. And then we went all the way down to the 100 period moving averages. They're right now holding as support. We tried to rebound off of that, but we went back up to S2. That was a resistance level. And we declined back down again to the 100 period moving averages. So it was kind of, you got this buy the dip mentality, which I don't do and I don't teach in my courses, but a lot of people do. They think, oh, here we go. We're going to bounce back up from here. So I'm going to buy. And it seems like the right thing to do at the time, only to have it not end up being the right thing to do. Then we rebounded back again. This time we were able to get above S2, but it just kind of ran out of steam. We declined back below S2 and closed slightly above the intraday low, which means we closed just a little bit above the 100 period moving averages. So when we're looking at the short term, we follow the 20 period moving averages. That was lost a while back. We tried to regain the 50 period moving averages, which is the intermediate term. And then I also plot the 100 period moving averages, which is more intermediate to a little bit of long term. And we're still below the 200 period moving averages. So that means the long term trend is still positive. We were down 1.54% on above average volume. Now, was this climactic volume, meaning that everybody was selling just to panic to get out of there? Or is this an increase in volume suggesting that maybe there's more to come? We don't know the answer to that right now. These are just questions that were running through our head. So we are now negative in the short and intermediate term. We've been that way. We tried to get the intermediate term trend back to positive after last Friday and Monday's positive sessions, but we lost that. In Tuesday's session, we went nowhere on Wednesday, and then we declined on Friday. It's because of interest rates. Now, I'm starting to follow a little more closely, and I'll be mentioning it in the videos with the 30-year bond. Now, usually I follow the 10-year bond yield. The 30-year bond yield is getting close to that 5% level. That's kind of a big deal. We haven't been there in a long time, and this could have a couple of different implications. First of all, if we break above 5%, that's going to be more negative for stocks. If we get up to that 5% level, that could be overhead resistance, and we could, because the bonds have been going down, 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 down. Interest rates have been going up, 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 up. They're going to at least slow down here and possibly go in the other direction for a little while. It may be if we get to that 5% level with the 30-year yield. So, and then in the meantime, the 10-year yield is still going up as well. So I'll give you the actual numbers here in just a moment. And that's what's really freaking out the market. We've got these geopolitical things going on. Of course, the big news right now is what's happening in Los Angeles with the fires. That doesn't necessarily have an impact on the market. It's a very sad thing that's going on, and let's hope that the fires can get under control and be put out really quickly because you hate to see those kinds of things happening. Okay, so some comments. The employment situation report came in hot, and I'll have the numbers to show you here in just a moment. Interest rates are going up, and that's in response to stronger than expected economic data. And that was just confirmed in Friday's session with the employment situation report. We still have this confirmed Hindenburg Omen still there. We don't have any additional spikes, at least as of yet. We'll have to see because there's a 1 day lag with this chart. So we just have Wednesday's update because the market was closed on Thursday, and then we won't get Friday's update until Monday's session. And then this is another thing that we've been holding on to because the NASDAQ and NASDAQ 100 had been hanging in there better. They were still above their 50-day moving averages. Nope, not in Friday's session. We dropped below that. So that is a support level that was lost. But we came down to the 200-day moving average with the small caps. See, that's why, yeah, I focus on the S&P, but I'm watching the NASDAQ, I'm watching the mid caps and small caps, because sometimes we get some support level or resistance level in a different index that then feeds over into the S&P 500. So for right now, and I would treat this as positive until proven otherwise, we are still above the 200-day moving average from the small caps. Now, the small cap should be just going up automatically right now. They didn't do that in December. So far in January, they're not doing that. We're not seeing anything kind of like this January effect right now. But a lot of people tried to front run this instead of actually seeing strength. They actually got in thinking, oh, well, yeah, they're going to go up and they're magically going to go up. Well, as long as interest rates keep going up, the small caps are really going to struggle because interest rates have more of an impact on smaller companies than they do on larger companies. And then we went from no list after Wednesday to a complete list now after Friday, meaning that we went down pretty far, pretty fast. We're already oversold. And this is what I'm talking about, the context, because the bigger picture is still positive. The shorter term picture, short term oversold, that's what this means here. We've already gone down pretty extreme. We're already getting an extreme reading with the 20 period exponential moving average, the Stochc RSI, Williams percent R, CCI 14 and 20, the stochastics in the short term, the slope oscillator, and then the 20 period boom indicator. We're getting kind of far away from the 20 period moving average currently. And we don't really have much in the intermediate term. We do have the 50-period exponential moving average. Now that's on the S&P itself. And the Arun finally woke up and decided to dive down to an extreme reading. And I'll have charts to show you of all these things. No change to the scenario. We're just kind of seeing played out what the scenario has been. That now you're seeing a lot of doubt coming up that, well, maybe the Fed shouldn't have cut rates last fall. They started off with a 0.5% cut, and market was all happy. Bond market was not, because that's when interest rates started to go up. They're still worried about inflation. And now you see a lot of folks really starting to second guess what the Fed did. And that's everybody does that. I mean, it's like, okay, the Fed did what it's going to do and the market's reacting. So instead of trying to blame somebody, let's just look at the charts and see what's being told to us right now. And they've also in the Fed, they increased their inflation outlook. And so far that could be happening. Now, next week or the upcoming week, we're going to get PPI and CPI. So we're going to get some inflation data. But the employment report that came out, this could feed into that inflation scenario because the unemployment rate went down. We saw jobs a lot stronger than expected. And I'll go through the numbers here. And that's kind of feeding into this inflationary scenario. The dollar was up, and that's another thing that's pressuring stocks too. We've got the dollar really going up solid right now, and interest rates were up. We closed at 4.78%. So we're above the 4.75. Now the market was already freaking out when we got to 4.5. Now we're at over 4.75, where we had been at 4.69%. And then until this doesn't become as big of an issue, I'm going to be tracking more of the 30-year yield as well. We're getting close to that 5% level. We closed at 4.97% in Friday's session. So we'll just keep an eye on that one. We may go up, hit that, and turn and go the other way. If we break through that, that is going to tell us a different story that'll be more negative. Sentiment is not extreme negative yet, but we had been at 32. We ticked down to 27. It's when we drop below 25. That's when we start to get extreme. So we still have some more room to go to the downside as far as sentiment. And we're trending now, and it's a negative trend. And we're above the moving average with the ADX. And since we're above 20, we're trending. The bias, because we had the down day, that's usually what bias is whether you had an up day or a down day. And sometimes I vary that a little bit, but this was clearly a down day. So the bias is negative, and then I've switched our momentum, which are the last 2, 3, 4, 5 days taken together. That's also negative now. Now, after last Friday and Monday, when we had pretty good up days, we were looking a little better and we were seeing some improvements internally happening. Those have pretty much been wiped out now, and now we're back to looking more negative. All right, so here is the non-farm payrolls, which came in at 256,000, over 100,000 more than what they had expected. They thought it would come in at 154,000. And this is also up from what we saw last time, 212,000. The non-farm private payrolls also grew a lot stronger than expected. 223,000, they expected 140,000, and up from 182,000. Average hourly earnings came in as expected. So that's not necessarily inflationary right now. We're not seeing a real tick up. In fact, it came down from the last reading. Last time it was up 0.4%. This time it was up 0.3%. Still going up, but not with the same rate as what we saw last time. The unemployment rate ticked down to 4.1%. They expected it to stay the same at 4.2%, which is what we had last time there. The average work week, 34.3 hours. That was what they had expected. And last time it was at 34.3. So that part didn't change. And then we also got consumer sentiment. Folks are feeling a bit more pessimistic about things. Last time it came in at 74. They thought it was going to come in at 73.5. It came in at 73.2. So a little bit more pessimism going on there. All right, so here are some charts. I don't show the job numbers because they're so skewed. This huge spike, this was the COVID crash, and it makes the chart almost useless. But we're coming in at 4.1% now. So we're ticking down with the unemployment rate, and then I combine this in red. These are the initial jobless claims, which came out on Wednesday this past week, where they're actually going down. And then the continuing claims, the blue line, that's actually going up a bit, but we're still seeing the moving average. When I show that chart individually, it's still declining. So this just tries to put all of three of these things into perspective. Here's consumer sentiment, where we did tick down to 73.2. I also plot the 2-year treasury yield on here, and we're seeing kind of a disconnect between them. Typically, they'll go in the same basic direction, which in a real choppy way they have been, but we'll have to see if folks were a little bit more pessimistic this time. So then this breaks it out. Where first we look at the blue line, which is coming down. That's the total reading. That's like the previous chart that I just showed. And then the purple line, folks are feeling good right now for some reason. But when you look out into the future, the yellow line, that's actually coming down. So they're not as optimistic about the future as they had been, or at least as they're feeling right now. Okay, and then this chart, we seem to show this once a week. This is put out by Real Investment Advice. This is a longer term chart, and it compares price with the S&P with earnings. And there's a real strong correlation. When earnings are going up, the stock market goes up. When earnings are going down, the stock market goes down. That's why, especially in the weekend videos, the weekly versions of things that I do, we look at earnings and see what's happening with all of that. And as long as earnings can stay positive and looking better as far as forecasts and projections, then that really helps the stock market to do better. All right, and then looking at the valuation, where the US market, now all these came out before Friday's decline, so this is probably going to come down a bit here, where we have a PE ratio and we use a 10, 15, 20 scale for that, which is static. We've been above 20 for a long time now. We're coming in the US at 22.2. So the market is considered to be expensive here. And this is forward looking. Now, it's one thing to see historical data and have that show that the market is expensive. But when you look into the future, it's still looking expensive, and that may justify prices coming down. And you have all US when you take tech out, that's a little bit under 20. And then we have the rest of the world here, just showing that the US market may be the strongest, but it's also the most overvalued right now. And then the rise in the S&P 500 in the past 2 years has been one of the strongest since 1928. Well, there's only one problem with 1928. It came right before 1929, which is when we had the huge stock market crash, which took us into the Depression. Now, am I predicting that? No, but I'm not predicting that either. We might be seeing a real shift now with what's going on economically. We don't know. We're watching the charts, we're watching the information. We'll be just seeing as things change. That's why I do the daily videos and just see if we are entering into a new kind of an environment. I put the red box around this because it's really, this goes all the way out into March. And it's like, okay, how can we get some help with things right now when all these lines are kind of close to each other? But this is just trying to look out in comparing where we're supposedly at right now and then comparing it to 1928. So, all right. And then the concentration median. I'm not quite sure what the concentration median is, but for the PE ratio, this is still coming in at a high level, but it's not as high as where we've been at before. That's kind of the takeaway here. And then this is why is the Fed raising or lowering interest rates or staying the same? This just talks about what happens after they start rate cuts. And you kind of get this whole spaghetti electrified mess here. And this is what we've been doing right now. 1981, which was a very good year in one aspect, that's when I graduated high school. But on another aspect, it wasn't very good as far as inflation is concerned and just trying to compare where we're at with where we've been before. And I'm not too sure this is all that useful. And then the equity futures by asset managers, they're pretty long. They're above this dashed line. They're getting caught right now too, where they were expecting things to be a lot more positive than so far they've been. And then we're getting kind of extreme with their optimism. Then gold, steady as traders mull, Fed rate path. Gold's been kind of chopping sideways lately, and this came out before the employment report came out here, and I'll be going over gold and silver and a lot of studies that we do there. with the weekend videos, specifically the intermarket analysis video. I didn't spend any time on Twitter or X. I'm getting ready to do all the weekend stuff. All right, here is the intraday chart. So we were doing okay. Now, if you go back to Monday, that ended up being a positive day. We gapped up and we were just off to the moon we go. Well, you start to notice that we topped out here and we rolled over. And if you just keep going down here, Wednesday was a non-event because it was right before the state funeral for President Carter. But we just kind of kept going here. Now, we did see a bit of a bounce, and this was looking pretty solid. And then it all stopped. And we came down and closed just a little bit off the low. The support level that we're hitting right here is the 100-day moving average. So we gapped lower below S1, S2. We came down a little bit above the 100-day moving average, tried to get up, hit S2, came down, hit the 100-day moving average again. This is all green and going up. It looked like, okay, the smart money's coming in and buying. But all that stopped. We just reversed down here. This was like some big sell program or something hit the market. We dropped below this volume weighted moving average here and closed just a little bit off the low. So so far this is a failed bounce at this point. It looked good there for a while. Maybe it started too early in the session. It might have been more positive if it started later on, but it ended up not being all that positive. Okay, and then we were down just a little bit. You see the light blue area here. This is when the futures market opens. And then the employment report came out, and boom, we went down. Of course, there was this buy the dip, which I don't do or I don't teach. And then that didn't really help things. And we ended up just cratering down during the cash session, tried to bounce, came back down, and just closed a little bit off the low for the weekend. Now, this is a positive area that I've been hanging on to for right now. Now, everything got hit on Friday, but growth got hit less than value. And you can see the red line, which is value, it's pretty weak right now. Where growth, it's not gangbuster at this point, but it's holding up, and the blue line is still above the red line. Even though they're on different scales, when the blue line is above the red line, that is more positive for growth. And this is holding up fairly well too with the growth to value ratio intraday for the S&P. We're not really going up right now, but we're not falling off the face of the earth either. And so this continues to hold up. Now, end of day, you see both growth and value were down, but growth was down less. It was also down less for the mid caps. It was down a little bit more with the small caps. All right, so looking at our small cap growth to value ratio, it actually ticked up a little bit, and we're still in an uptrend. Even though the index has been going sideways and now it looks like it could be falling apart and we're breaking below these previous lows, the growth to value ratio is holding up pretty well. We're seeing that same thing with the mid caps. It hasn't quite broken down below these previous lows yet with the index for the mid caps, but the growth to value ratio went up, and we went up with the S&P growth to value ratio. Now, this is also kind of an ugly looking chart here. We came down, we set a low, and I'd been pointing this out about a week ago where we had our high, we came down, we came up, we set a lower high, and then on an intraday basis, we broke just a little bit below this previous low. Now that makes the chart look more negative because now we're setting a lower high and a lower low. Well, look at what happened here. We went back up, we set another lower high, and now we're setting another lower low. And so this is kind of a dangerous looking chart pattern. Now, I'm not into all the, rising wedges and drawing triangles and, using a spirograph and all that stuff. But I do, you kind of watch what's going on here, and we see lower highs and lower lows, and that could end up being more negative for the market. That's the negative side. The positive side is that the growth to value ratios are still holding up pretty well. Now, we took a bit of a hit here, but when we look at the growth to value ETF, we're still getting a very high reading with this. And discretionary to staples still looking pretty good at this point. Now, we did break some support here with large cap growth. We ended up breaking down below the 50-day moving average. That had been holding. Well, we lost that in Friday's session. So that's turning the large caps a little bit more negative. And our trend is negative. We're starting to go up with the ADX. We're above the moving average now, and the red line's going up. We're above 20. So this is a negative strengthening trend that we're seeing here in the intermediate term. And then in the short term, we're also above the moving average, the red line going up, the green line going down, and we're above 20. So that's why one of the reasons why I say the short and intermediate term trends are now negative. Part of it is based on the two charts I just showed here. We did pick up with volume. We were above average with that. And sentiment, one sentiment indicator that we look at is the ulcer index. We ticked back up and we're above the moving average, showing fear. And we went back up with the VIX. Now, we're still below 20 with the VIX on a closing basis. And we got close on an intraday basis. Not quite there. But if we break above 20 with the VIX, that's also going to turn things more negative. That's when we see negative annualized returns. Now, it's not doing any great thing right now, and it is going up, but at least it's below 20. The market uses that as the line in the sand between, okay, we're a little bit more positive when we're under 20, we're a lot more negative when we get above 20. And the VIX of the VIX, which measures the volatility of the VIX, also going up both with the bar chart here and the line chart. And the momentum of the VIX is now starting to turn up because stocks are going down. We're still getting a high reading here with the skew index. It's still up in this red area. Now it's coming down. We actually ticked up a little bit in Friday's session, but the market is still expecting some kind of a big move that hasn't happened yet. Well, we had a pretty big move on Friday, and this actually went up. So that the possible faulty conclusion that we can reach with this is that the move that's being expected is to the upside, and that hasn't been happening. And so the up days that we saw did see the skew index drop, and we had a down day, and now this is going back up. And it could be a lot of folks that are anticipating the market going up. Now, this is again just pure speculation on my part. I don't have data to back this up. This coming Friday will be options expiration, and a lot of the folks who may have got into this, because this is measuring options. This uses out of the money calls and puts to calculate. And they probably got into the January options back in December, because we've been riding this now for quite some time in this red area. If they did get into January options, those are going to expire in the upcoming Friday. So we have another week to go. We'll just see. Is this chart going to change? Now, that's a week off from now, but it's just something to be aware of. And we'll see if this ends up adjusting this overall chart. And we just barely ticked up here with this fear gauge, and we went up with this other fear gauge. So we're seeing some slight confirmation with the ulcer index and then this previous chart and this chart. They're all being confirmed that fear is increasing in the market. We did get the latest reading from the American Association of Individual Investors, and for the first time in quite a while, they've actually dropped net negative. They had been positive, and we're starting to see the 50-day moving average of this sentiment gauge start to go down now, where it had been going up for quite a while. So this sentiment is also looking more negative. We're coming back down with our risk on to risk off ratio. We're back down into this range. When we were going up, that's more positive for the S&P. Now that we're coming down into this range area, again, it's more indecisiveness, if not even a little more negative. We really went up with the daily chart of the equity put call ratio, but we're going down now with the 5-day. Here's a longer term look at the 5-day chart. And when we get below this green line, that could mean that we're getting extreme, which means that there could still be some more room to the downside based on this chart. But the 10-day chart is back to going up. So we're seeing some contradiction there. And not seeing really any change with the volatility risk premium. It's not predicting any fear going out into the future. It's below the band and actually declined in Friday's session, where if we had a down day, this usually would really go up. Well, it kind of did the opposite. All right, looking weaker here with our advanced decline line studies, coming down based on price and volume, but longer term we're still positive since we're above these advancing moving averages. Now, this had been showing possible signs of improvement. We were starting to turn up with the 5-day and the 10-day. When we look at the new highs and new lows and then take the moving average of that, we saw a really big expansion of new lows and a few new highs, but not very much. And so that's turning the 5 day and 10 day back down where this was giving us some hope. This is another internal measure that we look at. And when this is looking weaker, then the market is weaker. And we're negative now with accumulation distribution. Now, don't pay attention to this indicator down here, but this is the boom indicator, and it tries to measure how far away are we above or below the indicator from the red line, which is a moving average. And you can see it's already given us an extreme negative reading where we're just barely below the moving average here. So it's as close as I could get with trying to replicate what you see here. But we are negative since we're below the moving average, and the moving average is ever so slightly starting to go down. So this smart money indicator is negative. Now, the reason why I call it a smart money indicator is it takes price and volume into account. And we're negative here with the advanced decline ratio, both in the short term and intermediate term. Short term is 19 periods, intermediate term is 39. That's looking more negative there. This is a further breakout. We're below zero with the 19-day advanced decline ratio based on price and volume. This is interesting and could suggest the smart money is coming in and doing some buying. The Chaikin money flow, which is another smart money indicator, which uses price and volume to calculate, it went up and the red line's starting to go back up. Now we're still negative since we're red, but to have the big down day that we saw on Friday and to see this going up, somebody's in doing some buying. So this could be somewhat positive. Now we're concerned about the chart pattern that we see here with the lower lows and the lower highs. But the smart money, they're going to do what they want to do when they want to do it. And so this could be somewhat positive right here since the red line is going back up. We're still declining though with our other smart money indicator, the chicken oscillator. It continues to decline. And we're negative with the vortex. The red line's going up, but the green line came up a little bit too. Interesting with that. Looking at the cumulative advanced decline line for the S&P based on price, didn't really move all that much. We had a pretty big down day, and this just kind of ticked down a little bit. We did decline a little bit more based on volume, though. And we're below zero and declining with our advanced minus decliners, and then a 10-day moving average of that. If we get down below this green line, that's suggesting that we're getting extreme negative. And other times when we get down to this kind of a reading, sometimes we reverse out of that, but we're not there yet. And it could go lower than the green line. And this is interesting too. When we look at the NYSE advanced decline line here and then compare it with the S&P, we're down to the 200-day moving average now. Now this is measured on the NYSE advanced decline line, not the S&P. We haven't been down here in the history of this chart, which goes back about a year. Could this produce some kind of support to come up out of that? And this is longer term, the 10-day average of the highs and lows for the S&P. We were starting to bounce back up. We came back down in Friday's session. We're below 50, which makes this negative. Now, we saw a little bit more weakness here with the cumulative advanced decline line on the NYSE. That's falling below the moving average, and we're starting to roll over with the moving average with our regular NYSE advanced decline line, and we're chopping down, but we're not really breaking out to new lows, at least yet. And this other NYSE advanced decline line, which is calculated in a slightly different way, also looking more negative. When we look at the common stock on the NYSE, we're declining here based on price, a little bit below this previous low, but we haven't come down to this previous low yet based on volume. Could this be a positive divergence? Possibly. We're not looking good here. The advanced decline lines of all the indexes below the moving averages and declining, and the moving averages are starting to roll over. And we're back to a little bit further below zero here with our 5-period moving average of the highs and lows across the broad market. We were showing some improvement, but now we're not showing that improvement as much. This is the stocks inside of the S&P 500 and the percentage of those above their 20-day moving averages. We're dropping back below 20. We came down, dropped below 20. Came back up to 20, drop back down. Broke above 20, now we're coming back down to 20. Is this some kind of bottoming process that's going on here? Just a question that doesn't really have an answer right now. And the study that we're looking at. Now, one thing I was pointing out is that we came down, broke below 10, went up, came down, set a higher low here. That could be a positive divergence. Well, then we declined pretty good on Friday. We'll have to see. Is this going to end up setting a higher low here? Just something to watch for. That could end up being a positive setup. And we're dropping below 20 now again. We're getting quite negative with those stocks above their 50-day moving average. Really going down with those stocks above their 100-day moving average. And we need to be a little bit concerned here because we're at 50.8 now with those stocks above their 200-day moving average. If we drop below 50, that's going to turn this chart and this study on a long-term basis over to negative, which we haven't seen now in a long time. All right, short term breaking further below the 50-day moving average, and we did pick up with volume. Here, we're getting extreme with the 20 and 50 period moving averages on the price of the S&P itself. We're declining with the 200-day moving average steady, getting a little extreme with the boom indicator based on 20. That means we're getting kind of far away from the 20 period moving average. We're negative more, dropping below the 0 point with the 50-day moving average. We're declining, but still above zero with the 200-day moving average steady. And now we're showing here that the momentum in the short term is clearly negative, but we want to keep an eye on this because, again, as I've said now a couple of times, the bigger picture is still positive. So when we get down into this area, we might ride it for a while, but we may not ride it for too long if the longer term picture is still going to remain positive. But we're looking extreme negative here with the Stochc RSI, the Williams percent R, CCI 14, and the CCI 20. The short-term stochastics is extreme. We're declining, but not extreme with the intermediate short-term stochastics, and we're still declining with our longer-term stochastic. Declining more here with the force index, but we're not all the way down to this Keltner band, which means that we're not necessarily going down too far too fast. And the condition of the short-term trend measured by 20 periods, the double and triple exponential moving average study continues to show weakness. And we're below the 20 period simple and exponential moving averages, and the lines are going down. We're going into the -2 channel with our standard deviations chart, which also means that we haven't, to this point, gone down too far too fast. If we get into the -3, that's when it's like, okay, maybe we've overdone it here. All right, intermediate term. Balance of power actually ticked up a little bit, but it's still negative. That's kind of interesting. Go, no go, dark purple, smoke on the water, highway star, space trucking. Not looking really good right now. And we're coming down to the lowest low value with this chart. That's also more negative. And after showing some slight improvement with the TTM squeeze, we're turning back to the darker shade of red and going down again. That's turning more negative. And we're still just hanging out a little bit above the moving average with standard deviation. That's measuring speed over the last 10 periods. We actually went up with the ease of movement. Kind of strange there to have the down day that we saw and to see this indicator going up. Ease of movement tries to measure the path of least resistance, and it's picking up something positive. All right, and then the Arun indicator really trailed off here. You could suggest that we're getting to an extreme negative reading here with this oscillator. And coming down with the S&P McClellan oscillator, we weren't able to get back above zero, so we're coming down. Whenever we're below zero, that means we're declining with the summation index based on price, and now we've turned back down based on volume. After Wednesday, we were seeing a mix where price was going down, but volume was going up. Not happening now. They're both confirming each other to the downside. And we're also crossing further below zero with the NYSE McClellan oscillator. So we started to try to tick up and we were looking a little bit more positive based on volume, but now we're going down with the summation index based on price and volume for the NYSE. And this was giving us some hope too. We actually crossed a little bit above zero with the Swenlin trading oscillator based on price. Now we've crossed back below zero. We were coming up close to the zero line. We're rolling over based on price here. So we're losing the positive side that this was trying to tell us. The positive thing didn't happen. Momentum, when you look at the PMO by itself, clearly negative. We were trying to improve based on price and volume, but now still at their moving averages. And we were seeing some improvement here with the PMOs rising. It was looking better, but now it's falling back. The buy signals are still looking okay, though. They're not really going up. They flattened out a little bit, but after being extreme negative, they're holding up a bit better. But when we look at the PMOs above zero, that continues to decline. And we still have a little more room to run if we're going to go all the way down to this 20 reading. The slope oscillator, which looked like it was improving, but it was still below this red line. That's why it was extreme negative. Now it's rolling back over its moving average, and the MACD never did even get close to its moving average. It's turning more negative. So the slope oscillator, I use as short term. MACD, I use as short to somewhat intermediate term. Then I have a bunch of different oscillators here. I also have the slope and MACD on this chart where we're rolling back over here. We never did show much of an improvement with the other short-term oscillator, the TSI. The intermediate term oscillators continue to go down, and we never really blipped back up to positive with our long-term oscillators, the TRIX and KST. The Copic curve was trying to improve, but still below its moving average, so that's still negative. And we're coming down with the Sean trend meter. We're in this yellow area. The context is that we're declining, so that's negative. We actually ticked up a little bit with the money flow, but we're still below 50, so it continues to be negative. And we tick down here with the ultimate oscillator. We're also below 50. That's negative. And we're coming down, but we're still above the moving average with unbalanced volume. If we break below that, that could change this long-term trend that we've been seeing for 2024. That could switch things over to looking more negative. We're below 50 with the RSI 14 and the RSI 9. That's negative. And we're dropping below this long-term moving average here, and we went from neutral back to red with the Elders Impulse system for the S&P. We're negative with the parabolic SAR. The dots continue to be on top. And the condition of the intermediate term trend coming down, the blue line, red line declining. That's showing a deterioration of the intermediate term trend. We're below the simple and exponential moving averages here. It was overhead resistance in Wednesday's session. That was the high with the exponential moving average. Now we're dropping further below as we're setting a new intraday low here after setting a new lower high. Here's the 100-day moving averages. See how this is holding up as support? We're still above that level for right now. So we'll see if this is going to mean something or are we going to fall down below this. Now, based on what I study, the next moving average after this, if we break it, is going to be the 200-day moving average, which is our long-term trend measure. So here's all the different moving averages below the 20 and 50, and the 20s are starting to come into the 50s here on this chart. So far, the 100 is holding. The next one down would be the 200 if we continue to fall. Now, we're seeing some interesting things here, which could potentially be positive. The mass index. We go for months and don't even look at this chart. Now we're coming above the red dash line. If we go up above the blue line and then turn back down and cross back below the red dash line again, that's signaling a trend reversal. Now, it doesn't mean it's always going to play out that way, but that's what this indicator is trying to tell us. And another thing, we're starting to cross over with the Pring bottom fisher. Have we declined enough? Now, this is supposed to be when we see a climactic sell-off type of a thing. But if you go back to November, when we were after the election, when we saw the spike up and then we came down, this signaled something, and then boom, we had a nice little run here with the S&P. And then that got worn off, and we've been just not really paying attention to this chart. Now we're crossing back over. Could this signal that we might be at or near some kind of a bottom? And we get false signals with this chart, but we also get legitimate signals too. And we were basically positive with the bullish percent index. Not now. We dropped back below the moving average as it declined even more. The NYSE bullish percent index is negative, and we're dropping below 50 with the NASDAQ 100 bullish percent index. So all of these are negative now. And we're dropping below the cloud here, the itchy and scratchy cloud. The green area, we've fallen below that. So this is a bit of a concern. But remember when the day came when the world was ending? And that lasted, what, a few hours? We dropped below the itchy and scratchy cloud here, and then we came back out of that. But for right now, we're treating this as more negative since we're coming below the cloud. Send in the cloud. And then the green line is also going down, and the blue line's below the red line. And this kind of started it all, at least in my perspective, with the longer term trend channel. We came up to this upper trend channel line and we've been really struggling and going down ever since then. We are negative on a trending basis. When we look at the Heiken Ashi with the black candles, we're going down in red with the Kigi chart. We have a red box that's negative for the Renko chart, and the three-line break has black candles or bars, whatever we want to call that. Those are negative as well. We had three new O's drawn in here, and this is looking a little scary, where we went up and then we came down, and then we go back up and then we came down. Are we producing some kind of a topping pattern here? According to the point and figure chart, we can't seem to get above these X's. And we're coming back down, and now we're starting to draw O's here. Just something that we'll be watching. Long term, dropping below the 250 range here. That's kind of the midpoint with the 150, and we're coming down close to the 250 with the 200-day moving average. Just showing longer term weakness, but it hasn't turned negative yet. And I'm not sure what to make of this. It looks like we're probably going to go off the books here with this wagon YC breadth thrust. So, but we're still watching that. And then we're negative in the short term with all the different stock indexes. Mid caps and small caps are negative in the intermediate term. And then bonds are negative across the board based on price. Commodities, which have been going up now, a little more inflationary type things happening. They're positive in the short and intermediate term, and the dollar's just strong across the board. Every sector was down except for energy. That ends up sometimes playing in being more defensive. It was up. All the other sectors were down, with real estate going down the most. It does not like rising interest rates. And the tech, communication, and discretionary. These are the three big growth areas. They got hit too. Everything got hit in Friday's session. Lots of red here. But the only positive things we're seeing is that the dollar set a new 2-year high, and the energy sector had a BPI cross above 30. It's been really weak lately, but it's showing a little bit of strength. And when the dollar's setting a high, the euro set a 2-year low. But then everything else was red. Even Canada had problems. Oh, Canada, the 51st state, according to what rhetoric we're hearing right now. And yeah, and I heard somebody from Canada come out and say, well, we just might take, we just might want to buy California. And it's like, well, we'll throw in Oregon and Washington too. You want it? It's all on fire now. But anyway, a lot of red here. As the S&P crossed below 5,900, and then the NASDAQ 19.4, 19.3, 19.2, 19.1, blast off. And then we had the financial sector, which has been holding up but showing some weakness now. It had a BPI cross below 50. The Dow broke below 42,000. Real estate, which is just been getting hammered here, it has a BPI cross below 30. It's really weak right now. And we're seeing pretty much, the red line, that's the equal weight version. It's going down faster than the weighted version of the S&P. That's why the lines are kind of far apart from each other right now. Not seeing much of a change here with our ratio. Everything's getting hit. And the Dow, after it had been going sideways, it's starting to break out of this range that it's been in to the downside. It's negative after being neutral with the Elder's impulse system. This is another big thing. We broke below the 50-day moving averages with the NASDAQ. That had been holding up. We broke down through this before, but we closed above the 50-day moving average. We broke down and closed below the 50-day moving average. Now we're also losing the 50-day moving average with the NASDAQ 100. So we're negative with the QQQs, with the Elder's impulse system, and the momentum for the NASDAQ 100 continues to be negative, and it turned negative about midway through December. We also lost the 50-day moving average with the Qs. We were getting kind of positive here where it looked like maybe we're getting back above the 20-day moving average. Nope, came down. Now we've lost the 50-day moving average again. Small caps coming down to their 200-day moving average. Is this going to mean something? It did before, down in August, came down to the 200-day moving average, bounced up off of that. Now it gave all that back and came down to the 200-day moving average again, and then went up and then went sideways. But can this help give the overall market some kind of a support level to bounce off of? So far, this 200-day moving average is holding. Now, when you look at the Russell 2000 small caps, though, we're still above the 200-day moving average. I use two different small cap indexes. This previous one is the S&P 600 and the Russell 2000, and they're calculated in a slightly different way. We're starting to get extreme negative with the Russell 2000 with the RSI, and the momentum where it was showing some signs of improving now is looking more negative for the small caps. We're negative after being neutral for a number of days with the small caps. Mid caps holding up a little bit better, not really breaking out to the downside, even though they got hit on Friday too. But they've also changed over to negative now after being neutral for many days. And we're still below the 50-day moving average and declining with the Wilshire 5000. We're also falling further below the 50-day moving average with the total US stock ETF. The financial sector, this has been a stronger area. Not right now. It's falling further below its 50-day moving average. A little bit of a concern to us. The FANG index, though, these are the bigger stocks, the mega caps. We're still above the 50-day moving average here. Are we going to come down and test this and maybe get some support off of this? While at the same time, we're seeing a support level with the small caps. Just something to watch in Monday's session. And we're coming down to the lower end here of this longer term trend channel. Is that going to provide some kind of support level for the FANG index? Apple was down 2.41%, breaking below its 50-day moving average. And Amazon down 1.44%, but still above its 50-day moving average. Microsoft dropping below its 200-day moving average. Google down almost 1%, still well above its 50-day moving average, still above the 50-day moving average with Meta. It was actually up 0.84%. Nvidia dropping below its 50-day moving average, down 3%. Virtually unchanged with Tesla still above its 50-day moving average. Netflix, must have been some bad movies there, dropping below its 50-day moving average and down 4.25%. That's a pretty big move for Netflix. I'm actually watching a series on there right now that's not too bad. I don't know why it's going down. There's no connection between them, okay? It's kind of, I'm trying to be clever here. Staples dropping further below their 200 moving average. So this support level is gone now. I'll talk about it in the weekend videos, but I'm probably going to stop following this because it's not working out to what I thought might happen. The opposite is happening. And we're falling further below the 200-day moving average with our total bond ETF. Now, this is more important. We needed price to start going back up, which means interest rates are going down, and that's not what's happening. We're falling further below the 200-day moving average. And the longer we stay below these lines, we might see a death cross here that we haven't seen for quite a while. These are the things that we're going to watch for to see if 2025 is going to be morphing into 2021 to 2022. Not happening yet, but we're going to watch it. It took a while to unfold in 2022. We'll see if something like that is happening here. Semiconductors had been holding up down 2%, just about at their 50-day moving average with the SMH semiconductors. And then I was pointing this out too, where we came up to this level, fell back, came up to this level, fell back, came up to this level, fell back. Coming back down into the rainbow now with the semiconductors and back down to the 50-day moving average with the Dow Jones Semiconductor Index. And this is still in a longer term uptrend. The semi to tech ratio both got hit, but we were down a little bit more with the semi. So we're seeing this ratio going down. And this is more negative. We're dropping below the 50-day moving average again and in a downtrend with the SOX index, which is the semiconductor index. And not much of a change here with US to world stocks, kind of right around the midpoint here on the short term basis. Longer term, though, we're seeing that correlation firming up a little bit here. Oil is starting to go back up. Not sure if it's really geopolitical or just some technical things that are happening, more inflationary things could be coming into the mix. This helped the energy sector to do better. We're getting back up into 76, where we were hanging out around the 70 level for a long time. The dollar continues to shoot up here. We're at 109.49. My goodness, we're just really looking good. Great time to go to Europe. Great time to go to Britain. Great time to go to Japan if you want a good exchange rate. And we're continuing to go up here with the 10-year yield. Now, if we get closer to that 5% level with the 30-year, I'll probably start including that chart until that situation works itself out. And we're going down with the 10-year based on price. Further weakness here when we look at the ratio between home construction and 3 to 7 year bonds. That's a concern, but that's been coming on now. It started about midway through December when we broke this support, and we've been keeping an eye on this chart. But we're still looking pretty good here. The Q's to S&P still above the moving average, going back up with discretion into the S&P, but we're below the moving average, and the moving average is starting to come down. Large cap growth to large cap value still coming down to the moving average. We're not seeing these things falling apart. And we're actually improving here with the mid caps and the small caps. We're above the moving average, and the large caps are right at their moving average. You wouldn't see this if the market is really getting ready to fall apart, but there's some signals that the market could fall apart. All right, so what's our outlook for Monday? Okay. This should not be on here. The funeral is now finished, and I hope you all partook in that. And we are short and intermediate term negative. We had been seeing some improvements, but now they're pretty much gone. Okay, I didn't update this slide quite obviously here, so please forgive me and ignore that. Um, Now I did update this. This is the economic calendar for the upcoming week. We're going to get PPI on Tuesday, CPI on Wednesday, and then retail sales and jobless claims on Thursday. So we're getting some pretty big data coming out here in the upcoming week. And here's a look at the charts and what the previous reading was and what the forecasts are. Seasonally, though, January 13th, we are neutral to positive across the board. So not there's a little slight edge to the positive side. And then we look here with the 13th. Where's the green dash line? A little bit of positive seasonality here in the post-election year. And Monday is a fairly positive day, at least based on what happened in 2024. We're kind of getting up to the end here of the first half of January, which tends to do quite well. Tell that to 2025. And then we come into the second half of January where it also does okay, and we'll have to see if that can improve. Small caps going nowhere. They should be beyond the moon by now. And then we're still in this period, according to Tom Bowley, where we should be seeing positive seasonality. Yeah, not so much, at least yet. All right. And now, when we look at our smart money indicators, we're back to mixed, and this could be positive. Accumulation distribution, that's negative. But the Chaikin money flow is turning up, and the red line's going up. Chaikin oscillator is negative. Advanced decline line studies, not looking really good. The 10-day average of the equity put call ratio is back to going up. That means more puts are being purchased than calls, and that's more negative. And our NYSE and S&P McClellan oscillators and summation indexes are negative. And our bullish percent indexes, I had them on the positive side. I've switched them over here to the negative side now. Not looking good. Parabolic SAR, the Swenlin trading oscillator was on the positive side. Now it's back over here on the negative side. We're still negative with the momentum. We have a confirmed Hindenburg-Ullman, the vortex. Our moving average study's not looking good right now, and we're worried about the 200-day. Ease of movement, money flow, and ultimate oscillator are negative, and the momentum continues to be negative for the NASDAQ 100. Positive sign, but I've been saying this for like a month, maybe even longer, probably since the end of November. Growth to value holding up. Discretionary to staples holding up, but not transferring over into actual price action for the indexes. And the 5-day equity put call ratio is going down. That's negative. And we're just barely above 50 with our 200-day moving average study. Financial sector showing some weakness, falling further below its 50-day moving average, but it's still positive with the trend. Then here's the Hindenburg-Ullman, no additional spikes. We'll have to see if Monday something updates here. So our conclusion, we're negative, but we're becoming oversold in the short term. We could ride this for a while, but we could bounce right out of it too. And the large caps and growth continue to hold up. I feel like a broken record there, but it's what we've been seeing. It just hasn't mattered now for quite a while. In the short term, we're negative, but we've become oversold. Intermediate term, we're negative, but for right now, the 100-day moving averages are holding up. We are still positive in the long term. Thank you. Have a great weekend, and I will talk to you in the next video.